Okay, I think we are good to go. So, good morning. I would like to welcome Hein Schumacher, who is I was going to say new CEO, but you're not really that new now, but new CEO of Unilever. It's Hein's first time at the conference. So he doesn't know quite what he's let himself in for. Not that I'm trying to get you at all nervous ahead of this.
No, that's all right.
I'll ask you some questions, and then we'll spend some time opening it up to questions from the audience. So, first question. It's nearly been a year since you took over. What surprised you, both on the upside and also the downside?
Yeah, thanks, Jeff. And indeed, I think new after a year is probably. My board thought the honeymoon was over after 3 months. So you look. I mean, if I look back at the year, on the positive side, let me start with that. I think Unilever is a company with very strong fundamentals. Strong fundamentals when it comes to people, when it comes to processes, when it comes to our global presence. Obviously, we have a very strong stable of good brands. So strong fundamentals on the positive side. I think on the more critical side, for me, 2 things come to mind. I mean, the first one is I think our efforts and attention has been a bit too diluted. Doing many things, as I call it, a mile wide and an inch deep. My preference is usually to go a bit more an inch wide and a mile deep where I can. I think that for me is probably point number 1. Let me just pause it there. I think that is the most important one. And from there, the reality is you then get into what are the real priorities for the business, what are people targeted on, how are people remunerated, and so forth. But those are probably more second and third.
Thank you. You surprised me earlier this year when you incremented your midterm growth, which was quite surprising because at the end of October you said your midterm growth is 3 to 5. And then I guess a few months later you kind of came back saying, well, I think more 4 to 6. Now, obviously you've announced your intent to exit ice cream, but even with that, why make such a material increment in terms of your midterm view of the growth profile of the business?
Right. No, I think, look, we're indeed guiding in the midterm towards mid-single digit growth. And, if you think about it, we have a number of factors at play. I mean, first of all, is the demerger of ice cream that we intend to do by the end of 2025 or in the 4th quarter of 2025. That in itself will give us some change on the top line. Not too much, though, but it will give us some change. The second thing is, with the demerger of ice cream, our exposure to emerging markets and developing markets is going up from currently 58% in the portfolio to 65%. So mathematically, there is something there. Thirdly, last year we have increased our investments in brand and marketing by roughly 700 million. I see there is continued opportunity to really invest behind our brands and consistently. This is something I believe that we probably didn't do as much in the past. So that is another one. And then finally, by then we should be roughly 18 to 20 months in our growth action plan that we have announced in October with all the positive impacts that should come from it. So, the composition of those four things we felt was enough reason to say, hey, mid-single digit growth is a feasible number.
Thank you. Now, thinking about competitiveness, you've been quite vocal that you're not happy with the overall level of competitiveness of Unilever. But could you just elaborate on what the main areas are that are dragging that competitiveness and what are the plans to deal with them?
Yeah, sure. I mean, on competitiveness, and I would say the way I think about it is 40-40-20. So the first area of not being really competitive was Europe. That's 40% of the explanation. And, the reality was that Europe in itself, the European business, was somewhat deprioritized in the previous strategy. There was a high focus on North America, on China and on India, and not so much on Europe. This is something that I was actually quite keen to change on. You know, we have 18% of our 18%, of course, with ice cream that will change a bit, but of our business in Europe, we have a premium product portfolio overall. So we really changed focus in that sense. And you've probably seen in the first quarter and last quarter, I think, you know, there are some low-hanging fruits that we're taking by that renewed focus, by a step up in our investments. So I think that's a positive. The second one is premiumization in North America that we missed in some categories. You know, think of skin cleansing or deodorants for that matter. That is a bit more sticky, so it will take us a bit of time to sort of get into those higher price tier segments. As you know, in North America, we operate through our prestige beauty brands. That's going extraordinarily well with 13 quarters now of double-digit volume growth. And then we have our premium business. Think of brands like Dove and Vaseline. But I think in that sort of in-between layer, where the consumer gravitated towards, we missed that in the past. So, hey, we're looking at that, but at the same time, I'm very keen to continue to grow the two businesses that we have. And then the third one, the remaining 20, is Indonesia. You know, Indonesia is a bit of a longer-term story for the company where competitiveness was lagging in over, you know, a period of 5 to 6 years or so. But that got exacerbated last year in November with consumer actions or consumer boycott, if you will, related to geopolitical tensions. And there I'm very cautious, also in 2024, on restoration of that. You know, the conflict in the Middle East continues, and we continue to see flare-ups of consumer action. So 40-40-20, 40 addressed, second 40 being addressed, but at the same time positive about our overall North American business. And Indonesia, I'm cautious about.
Thank you, Hein. Your growth action plans, or can I call them gaps? Do they call them gaps internally?
I mean, with the growth action plan, I mean, the acronym is GAP, of course. So it's either to say, hey, we had a gap to close, which I talked about, and we're absolutely determined to do so. And where we have a gap, or where we have a lead, we need to extend the gap to the competition. So it can go both ways.
Right,
yeah.
Okay. Well, I'll roll with gap.
Yeah, sure.
So, you know, when outlining your gap, there seems to be lots and lots of focus areas. You know, I think there's sort of 10 different focus areas. There's been the biggest organisation change I've ever seen in, you know, the longer than I'd care to admit I've been looking at Unilever. Is there not a risk that there's just too much happening here? You know, and we have seen in the past that sometimes when staples companies try and do too much too quickly, it starts to go wrong. You know, what are the risks of that happening at Unilever?
I mean, it was interesting that you say that there's a lot in the gap. You know, the mantra of the gap for us is all about doing fewer things better and with greater impact. And actually, the gap is quite simple, in my view, Jeff. I mean, it's three things that we're focusing on. One is a more healthy top-line growth, and for me, that is a third. So that is price, mix, and volume. The second one is all about productivity and simplicity. And the third area is to dial up the performance edge in our culture. Those are the three big themes on the growth action plan. And if you think about it, on the healthy top-line growth, we are looking at going back to basics with unmissable brand superiority and making the market by fewer and bigger innovation. If you think about productivity and simplicity, I was very focused on improving our gross margin. Our gross margin went back too much versus pre-pandemic levels, and we didn't restore it as quickly as I would like to see it. So that's an area of focus. And then, of course, the performance culture or the performance edge in our culture we changed leadership, we did remuneration changes, and we changed the structure of the company, as you say, to go to much more to single point accountability rather than having a matrix. And yes, that's a lot. But at the same time, it was needed to do it, and I feel that the organization is rallying around some of these bigger themes.
Thank you. And the performance has been surprisingly good. I mean, surprising relative to market expectations. Yeah. The last few quarters have been strong relative to where the market was. Is that the impact of the gap, or is that still to come? Yeah. why do you think that the performance has been a bit better than expected? Is it due to some of the things you've put in place, or is that still to come in the future?
Look, Unilever is a big ship, and I think I want to be a bit humble and modest here. A year in the role and then saying, hey, all the good news is a result of that plan, I think wouldn't be right. At the same time, we are seeing some, as I said, some green shoots, and they are coming through. So, for example, we've been very clear on volume growth, that is important, and to restore, customer service levels, for example, that we had some operational issues that we were addressing. So I think that's probably one of them. By the end of the year, you've probably seen the enhanced gross margin. We're not reporting that on a quarterly basis, but we did it by the end of the year. And we're super focused on driving net productivity in our supply chain. And I see good things happening there. The third green shoot that I would point towards is the innovation and the fewer, bigger, better idea. That, for me, is a very important indicator. We have launched for example, here in Europe, we've launched a product called Wonder Wash, which is a laundry detergent for short washing cycles. We launched it in the UK, and we've been very clear that it has to be immediately scalable for all across Europe, and that's exactly what we're doing. We did stop quite a number of smaller projects in nutrition, but instead we put more money behind the scaling of Hellmann's plant-based mayo, which is supposed to be a €100 million platform this year. Just to give you another example, we introduced Liquid IV, a huge success story in the US, in the last months, into Canada, into the UK, in the Netherlands, Belgium, and Australia, and I'm very excited about that. So some of these things, yes, they are probably a result of it, but we're running a marathon here. It's a big ship, and let's stay very grounded.
Thank you. Moving on to sort of portfolio, you've announced your intention, as we discussed earlier, to exit ice cream by the end of 25.
Yeah.
Why should that create any value whatsoever? Surely there's just dyssynergies from ice cream moving outside Unilever. Why should shareholders be excited about that?
The demerger plan of ice cream and the spin of ice cream is really because it's not that I felt it was a bad business or whatsoever. In fact, it's a very good business. And if you take a bit of distance, it is probably it is our most premiumized business on a relative basis. If you take the top 5 global brands in ice cream, 4 of them are probably ours. And it's a very good business. However, I believe it is a distinct, different operating model. It's much more seasonal than the rest of the company, and it needs therefore a more agile and more flexible cost structure. It does operate at a much higher or lower return on assets. It needs almost twice the capital expenditure. It is more separable, so it has less synergies with the rest of the group, given our out-of-home nature of the sales force, but also of all of its distribution. And of course, it's frozen as a chain. So when you allocate your capital and your resources, I think within Unilever it would probably have the shorter straw, but it needs that flexibility and it needs that capital structure through which it can fly, and that was the result of the strategic review that we did, and I'm very confident that it will.
And I think you've previously commented that a demerger was the most likely route. Is that still the most likely route?
It is the most likely route because we made this decision, based on a strategic review that we did. I mean, we didn't engage with parties or, we didn't have conversations with strategics or buyers or whatsoever. We made a call, we discussed it with the board, and we announced it. So it is the most probable route, but at the same time, I didn't want to close any doors for other options if they come to the table. And in that sense, we're going to be guided by value creation.
Thank you. So if I take the Unilever portfolio and I take out ice cream, I would see beauty and health and well-being, I'd see personal care, I'd see home care, and then I'd go, nutrition. You know, it would just feel a little bit odd, yeah? So, you know, why does nutrition have a long-term role in Unilever, you know, given that, you know, it's going to be a kind of, you know, relatively isolated food asset in a HPC business?
Yeah, I mean, I get the question a lot, and you know, we went through that exercise in the first couple of months in the year very thoroughly. So we went. It was sort of the moment to really look at the company as a whole. But when I talked about the distinct, different business model in ice cream, and the financial algorithm in the ice cream business, if you then look at the food business, to be honest, I prefer to call it a food business. You know, it's actually very different. First of all, I think we have an opportunity to streamline it and make it super clear to everybody what it's all about. And it is a good business in sauces and in dressings, whereby 2/3 of its turnover is generated by the Global Hellmann's brand. And then there's a few other brands, mostly in mayo and some in mustard. That's doing actually well. They are accretive to margins. They are actually have been accretive to our growth on average, including the HPC business. The second leg of the food business is cooking aid, in which Knorr is more than 2/3 again of its total turnover. And also that brand has been accretive to margins and has been accretive to growth. And I think if we're very focused on it, what you see is that that business is on the periphery of the plate. You know, it's not center plate. It therefore has good margins. It's less vulnerable to private label. Less vulnerable to, you know, obesity, drugs, because I get a lot of that on that question. And very importantly, they are important carriers of our emerging market business. I mean, don't forget, when you get into 65% in emerging markets, 35% out of the total 65% of turnover is to general trade, i.e. mom and pop stores. And they don't do category buying. You know, that's one truck, it's one order, it's one delivery system, and there are very few food brands that can actually stand on its own in large emerging geographies such as Brazil or Indonesia or Vietnam for that matter. You need critical mass to do it. And I feel that all of these reasons together would plea for a more streamlined, a clearer, but certainly an inclusion of that food business in Unilever.
Thank you. And last question on portfolio. I always like to read reporting accounts in sort of great detail. I guess I've been an analyst for too long. But the chairman made a comment in this year's reporting accounts that until you deliver faster organic growth, he doesn't think you should be considering large-scale acquisitions, which is just a subtle change from previous commentary about not considering large acquisitions. So is this a bit of a shift of Unilever's view on M&A, or at least the chairman's view?
Yeah, I think Ian and I are very aligned on that. We like the organic growth trajectory, and you've probably seen that the growth action plan is, and what we talked about earlier, is very executional, very pragmatic in nature. You know, I think transformative acquisitions in the consumer space, well, a few have worked, but not that many. So I actually prefer some more pruning to streamline the businesses that I talked about, whilst continuing to expand in some of our really, you know, some of our strategic businesses. I mean, for example, we did an acquisition last year in December that closed in February this year of K18, which is a damaged hair care brand, or not the damaged hair care brand. It's a hair care brand for damaged hair repair, and doing extraordinarily well at this point. I mean, it's delivering on the business case, early stages, of course, but that's the type of business that I really like, because you can then fuel those businesses with science and technology that we have available in the company. And you know, we've done some more bolt-on acquisitions in the past in that space, and you know, take a brand like Paula's Choice, which is also in the prestige beauty side, mostly in the US, of course, or Dermalogica for that matter. You know, I would say 9 out of the 10 acquisition or 9 out of the 10 innovations they do are actually somehow from the R&D Unilever kitchen. So we have some strong R&D platforms, about microbiome, about the use of biotechnology, about renewable packaging, for example. And if you reason from those platforms, they can, in the future, and with a more streamlined portfolio, probably fuel around 80 to 90% of the businesses through different brands, through different applications. But that's something that I really, really see as a good model going forward.
You mentioned it earlier, Hein, Indonesia, which used to be Unilever's arguably number one business.
Yeah.
It was the poster child. I remember going to the CMD in Jakarta and hearing how great the business was. The last decade has not been great, to put it mildly. Now, obviously, we've had the boycott recently, but just putting that aside, what has gone wrong in Indonesia, and why could that not happen in India?
So, look, I don't want to oversimplify it, but my analysis is when going, and actually I spent quite a bit of time there last year because of that, exactly the question that you had. And I would sort of come down to 2 key reasons. One is a fast-changing retailer landscape and go-to-market landscape in which, more modern trade, i.e. convenience trade, took over from general trade. We were the kings of the general trade. And I don't think we were simply ready for a different go-to-market and a different retail environment. That's number one. Number 2, local competition coming in, and I think we have always been very focused on multinational competition and local competition coming in at lower prices, but with good quality products, and we were simply not ready to compete. If I sort of take a bit of distance, then I would come to those 2 conclusions.
And why does that not apply to India?
Because I feel that we are recognizing, both factors, early. The second thing is, in India, when you talk local competition, we are, quote unquote, a local company. We're so deep, of course, in India. We have competed with local companies throughout. And in fact, the competition in Indonesia was always with multinationals and became increasingly with locals. And in India, it's actually quite the other way around. With always had competition from local players. Of course, now many of the global competitors are reallocating funds and resources to India, which I understand. The second reason is on modern trade. That's a mistake we're definitely not going to make again. I'm absolutely determined to win in modern trade. India is 85% is general trade, 15% is a form of modern trade, and I feel that capability-wise we are well suited to do that. I would actually say on modern trade, maybe to give a statistic, our shares in modern trade are actually higher than in general trade. So with modern trade rising further, I would actually expect our shares to probably gravitate a bit more towards the national average, and therefore come down a little bit. But of course, we would grow the pie.
And just on India, it's been uncharacteristically sort of low growth for the last few quarters.
Yep.
An element of that's just sort of inflation cycling out. Where are we now in that cycle? I've been saying to investors, just wait a quarter or 2, volumes will start to bounce, it'll all start to look great again. Am I saying the right thing?
Well, you're right. In the last quarters, and we've guided towards that for the first half, is that in India, pricing is under pressure. We had negative pricing in the first quarter, -2%. We compensated with 2% volume growth. And we're seeing that primarily in our home care business and personal care business with low palm oil prices and so forth. 2 things. One, we're seeing inflation coming back a bit towards the second half of the year in the main commodities. And amongst other the one that I talked about. So that's factor number 1. 2, we just had elections in India with an expectation on, hey, would policies for demand in rural areas continue? I believe it will. I think there will be some positive impact from that, of course, to be seen how fast and so forth. But I'm hopeful that in the next 1.5 year that will continue to give extra demand.
Just turning to prestige beauty, health and well-being, over 3 billion business. It's been incredible now for quite a long time, 13 quarters.
Yeah.
But it's still very, very concentrated in the US. Why are you not being more aggressive in kind of spreading the footprint of that business a bit wider?
Yeah, I mean, first of all, thanks. I mean, it is a good business. We've had 13 quarters of double-digit volume growth that you cannot carry on forever. So I want to also here be a bit realistic. But it's great. It's been a good story. I think that management, and Fernando was leading that business, as you know, now in the CFO position, has been taking a very wise decision to really make sure to establish that business in the US first and make sure that those brands resonate with consumers, with the leading retailers in that space. I was there a couple of 2-3 weeks ago, visited these companies, talked to the main channel owners and so forth. I mean, and I think we have established something strong. You've got to get your own castle right before you go somewhere else. But we've taken a decision this year, first of all, with the rollout of Liquid IV across Europe, which I talked about. Secondly, with the introduction of Ollie's into China, and that's going actually very well. Thirdly, by expanding Paula's Choice and Dermalogica in Europe, and also listing K18 very quickly in chains like Douglas here in Europe, where it's already available. So we are going about it, but I want to be selective. And when you go, you've got to go all in. There's one other thing that I should say, and that is some of the brands would have some barriers for expansion just because of recipes and ingredient use, for example, to do in Europe, such as Nutrafol.
Okay, got it. Thank you. You've made some changes to compensation, and one that particularly caught my eye was the move to focus on absolute EBIT at current exchange rates.
Yeah.
Unilever's always been a percentage, constant currency business. And I also hear management talking more about absolute profit, much more than they have in the past.
Yeah.
So is this, quite a change in mind shift for Unilever? And can you just explain what was driving it and, what it may lead to in terms of behaviours?
Yeah, so I think, Jeff, you're actually, it's sort of two questions in a way. I think the first one is going from underlying operating margin to underlying operating profit, and the second one about how to deal with the hard currency part. Now, look, I mean, if you look back over the last 5 to 7 years, we've been between 9.5 and 9.9 billion euro of profit, and that has stagnated. And of course, that has plateaued and led to the share price stagnation and so forth. I am absolutely keen to drive operating profit at the end of the day and grow that number, but not felt hostage by a margin target. We are focused with the whole team on 3 things. That is, 1, a healthy top-line growth, as I said it. 2nd, gross margin expansion. And 3rd, improved competitiveness in the second half of the 2024 and beyond. All right, so those are the 3 things. Then that will, if you do that right, the rest will come. I'm very convinced about it. We need to make sure that we then have enough investments, to refuel the brands, etc., etc. But if you continue to hunt a operating margin target, it will limit your ability to drive consistent growth for the years to come. So that was the reason to shift much more to underlying operating profit as an absolute number. Then your question is on hard and soft currency. I want to take a bit of a different stance on that because, yes, I mean, the world developments happen to you and devaluations, but to the extent you can manage, you need to. So Fernando and myself, I mean, with the team, we have actually adopted a 3 or 4 step approach to work hard on hard currency. 1, prioritize capital expenditure for productivity enhancements in the developed markets, Europe and the United States, North America first. So to expand gross margins in those markets first. 2, the productivity plan that we're talking about, together with the ice cream part, has most impact on Europe, corporate, etc., etc. So there is impact there. 3rd, where we can, to adapt our cost structure to our turnover structure. If you have 65% of the turnover in emerging markets, and we had 55% of the cost in hard currency markets, can you align that more through, moving certain activities to the hubs that we have? And finally, you are allocate, as I said earlier, Europe is an important market for us. So can you prioritize your investments and the allocation of capital, for example, acquisitions, to those markets that drive hard currency earnings, like we did with K18 in the US. So hard currency earnings matter to us. We understand it, that it drives ultimately that is a value creation opportunity. So we're focused on it.
Just before we move to questions from the audience, just one question on ESG. I think you're really quite brave recently by coming out and sort of refocusing Unilever's ESG initiatives, because you must have known that this was going to open up Unilever and yourself personally to a lot of criticism in certain quarters. So if you could just elaborate on what your thinking was and why you sort of saw a need to take that flak, as it were. What was the thinking behind all this? Yeah. I mean, Unilever has always played a leading role on the ESG front and has pioneered a lot in sustainability, as you know, and I think as you probably all know. And I want to make sure that we actually, in a way, continue to do so. But new times ask for a different style. I think if we want to have big impact on the world, but also in our own company, I thought it was very necessary to focus on things that really matter and where you can actually have the biggest impact. We had 35 external commitments on ESG, and they were very wide-ranging, including, for example, on how the energy usage would be at the end user. So, for example, whether you would shower short or long. That's for me very hard to control and to measure. But what I can have impact on is what type of packaging I provide, and is it less plastic and so forth. So first it was very much around plastics or very much around driving impact and focusing ourselves more because I thought that was super necessary. But it's not a step back in terms of that our ambitions on sustainability are suddenly a lot lower. No, in fact, I want to make sure that in the areas that we focus, we actually can drive impact and improve. I think we also had to increase measurability. Making sure you have immediate progress. The thing, I don't know who you're speaking to all today, but I know one thing for sure. Many of the goals that companies have set, or that CEOs have set for 30 is quite near in, but 30, 40, 50, we might not be around. But I hope we'll be around in 2025. So it did strike me when you look at the sustainability strategies and policies of most, they had a goal for there, but did they know what they were going to do the next quarter and the next quarter and the next quarter? And that's something, short-terming sustainability was something that became clearer to me that was actually super important to do. And therefore we have now embedded these goals into the roadmaps of our businesses, into the roadmaps of supply chain, into the roadmaps of R&D and so forth. And I think that was an important change to make. So yeah, we took criticism, but I see it turning. And history will judge whether that's right. Great. Now, I'm quite conscious of time here, Hein, so I shall take my spectacles off so I can see the audience. So if anyone has any questions, if you would please raise your hands. Come on, please don't be shy. There's a gentleman there.
I think we all know people who worked at Unilever in the past, for most of us, and I certainly know quite a few people who work there. It still seems, from their perspective, feedback from them, that it's an incredibly complicated, siloed organisation where still masses of duplication occur. Is that your view at all, or am I just speaking from a very select group of feedback people?
Just let me know who you talk to, I would say. But
they might be part of that productivity number.
No, I'm not threatening. No, we don't. We should never get into a threatening culture. But I'm reflecting on. Look, I think we had a very complex organization, and as you may have, I mean, the first question of or the second question of today was around, doing fewer things better and with greater impact. We're really with the leadership trying to get our hands around, doing those things that really matter in everything. Whether it's on ESG, which I was quite long about, but I used the opportunity, or whether it's about driving unmissable brand superiority and doing bigger innovations behind top 30 brands. We're doing that all to secure execution and implementation of the big themes. Not because other brands do not matter, but I'm absolutely keen to drive a certain pragmatism throughout the organization. The other thing is that we've done is on structure. When you talk silos, look, we got an organization that changed to 5 global business groups in the course of 2022. When I joined the company last year, a little bit shy of 50% of all the people were somehow belonging to one of the 5 business groups. And that meant that many others were still in different roles, corporate-wide, enterprise-wide, whatsoever. We moved very fast, and by the end of 2023, we had 93% of our people belonging to a business with clear roles. I am absolutely sure there is a lot of opportunity to further improve and simplify, which is one of the reasons we're doing currently the productivity exercise. And that is not an easy exercise to go through, because Unilever, despite the restructuring that we did, we never went through an exercise, as you said, that is currently happening. So, look, we're an organization that's changing. We're an organization that's transforming. And I want to be realistic. It's a big ship to turn. But I think we have a really good momentum and an opportunity. And fortunately, I'm not alone in that. We worked the growth action plan. I was fortunate to handpick last year in the summer 40 of our senior managers, not in the Unilever executive team, but actually below, the ones who are steering a business. Think about someone who is responsible for deodorants in Brazil, who I remember was part of it. Think about someone who is responsible for hair care in Vietnam, who was part of it. And those people, they are not complacent at all. They are hungry. They want to win in those markets, and they were absolutely tired of not winning. And that, I think, will help us to eventually transform the business.
So we have 1 minute left. Can we please have one question? And if no one comes up, Gerard, I am looking at you, just to be warned. Gerard.
So among the big themes emerging, there is aging population, there is obviously AI. They could be seen as opportunities or challenges. How do you think about these two themes in the definition of your strategy?
Super important themes. First of all, in the growth action plan, we talked about digitalizing the company further. AI is a very important lever on that. It did strike me when we did an inventory. We have done 500 experiments on AI in the company, but at this point, we're boiling it actually down to bigger, once again, like we talked about the other things, fewer, bigger, and better. And I see a few key themes emerging. One is on driving revenue growth. And I think AI is already helping us in 2 specific areas, but we need to make it much bigger. First is in speeding up product development cycles, so in R&D. By building digital twins and therefore testing your products, for example, on skincare. And actually, it's interesting when you talk about aging, these things can go hand in hand. Think about skincare for anti-aging. Think about hair care products. We just introduced our first gray reversal shampoo under Living Proof in the US.
Could you please send me some? I don't have much, but what I do have, I would be quite happy if it wasn't grey.
Hair thinning is another one. We all suffer a bit from that. But but those type of things you can actually test very strongly through AI, and we're working with partners on that. The second area is on making marketing even more personal. So that your online experience when we advertise is really oriented at you. Would go too far to go too deep, but that's too. I would say 80% of AI is around productivity gains, and I see the biggest opportunity that I think consumer companies have is to make the whole forecasting and planning process touchless and integrate it much more with the retail side. That's what we're working on, and that's where we're going quite big. Then there's a third area, and that's changing the culture. We have given, I believe, by now 10,000 of our people the co-pilot, and there I would say the jury is a bit out. I don't know if you use it, and it's great that it helps you to summarize and answer emails and all of that stuff. But I'm not sure that is going to lead to an immediate cost effect. But the other 2 areas are very meaningful, and we're doubling down on those.
Quickly on aging, maybe aging population.
Yeah, aging. As I said, the things that we're mostly looking at is in our beauty and well-being business. And I would say I talked about the things that I talked about, but there are. Longevity is a big program in beauty and well-being, so we're focusing mostly on that.
Hein, thank you ever so much. Please do come back next year. I hope I have not put you off. And everyone, I think there's a break now, if I'm correct. So please do enjoy your lunch, and thank you, Hein.
Thank you.
Thank you very much. Good. Thank you.